One of the stocks I recently added to the portfolio is Alphabet, ticker symbol GOOG. Now, this is one of the big tech companies, so it may not be the kind of company you think of when you think of asymmetric investing or the kind of stock that is going to 10x in value over the next 10 years. But I actually think that Alphabet has a lot going for it, and it's more than just a search company today. On top of that, you're getting a pretty reasonable value for investors and a company that's actually buying back stock pretty rapidly. So I want to go through my thought process with Alphabet, break down some of their business units and what I'm excited about in the future, and why this is my latest buy in the asymmetric investing portfolio. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, the Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. I want to start with a basic overview of Alphabet and at least the financial metrics. And these are some of the main valuation metrics that I look at on a trailing basis. Price to earnings multiple, 25.6. So that's not cheap, but it's not bad for a company that's grown revenue at an 18+% rate over the last 10 years. Enterprise value to sales is 5.3. Again, a little bit on the higher end, but this is a tech company, so a lot of operating leverage on that revenue. So that's why you're going to be a little bit higher multiple than you might for like an industrial or an energy company. If we look at the next 12 months, that's in the middle of the screen, you can see that the price to earnings ratio is under 21. So we're getting a little bit more reasonable. Enterprise value to sales is 4.8. So analysts are expecting a little bit of growth, a little bit of improvement on the bottom line. And that's one of the reasons that the stock, I think, is a fairly reasonable valuation. So the valuation metrics, if this was just any company and there wasn't a lot of optionality, may not be one to get excited about. But you start breaking down Alphabet's business, and I think that's where you see a lot of opportunity. This chart has a lot of information on it, but what it shows is a few of the segments that Alphabet reports. Now, the company does not report everything or operating income from every segment. I hope they do more of that in the future, particularly from YouTube. But these are kind of the three main businesses that are driven by advertising: the Google search and other revenue, YouTube, and then Google network revenue. So the three of those together are going to constitute not only a vast majority of Alphabet's revenue, but also a vast majority of its operating income or net income. So you can see the first blue column is going to be search, traditional search, so steadily growing, but that growth has slowed a little bit recently. That's partly because of a slowdown in advertising, partly because of app tracking and transparency changes. But I think this is one of those businesses that you're going to see slow and steady growth, maybe not even in double digits over the next decade. But this is such a profitable business that I don't see it going anywhere. YouTube, again, very strong growth, $8.15 billion in revenue in 2017. That's up to $30 billion over the last 12 months. And then network revenue is the other piece that is also steadily growing, about the same size as YouTube. You combine those three together, and again, we don't know exactly what margins look like on YouTube specifically or search specifically, so they're kind of hiding the ball there. But operating income is this purple column, and that is over $90 billion just from these main segments. So that is a vast majority of the money that Alphabet is generating, but it's not the only reason to be excited about the company or the stock. Google Cloud is the other big business, and this has been a massive growth business for Google over the last few years. You can see that going back to 2017, a little over $4 billion in revenue. That's now up to $31.2 billion in revenue. And this segment is now profitable on an operating income standpoint. There are a few reasons to be bullish on Google Cloud specifically. The main one is artificial intelligence. As artificial intelligence becomes something that more and more companies are building on top of and looking for capabilities, there's really two main ecosystems being built out. There's the ecosystem driven by OpenAI, Microsoft, NVIDIA, and that suite of companies that are using GPUs to do not only training, but also inference. Alphabet has gone about things a little bit different ways. They have developed their own tensor processing unit or TPUs and basically their own artificial intelligence ecosystem. So if they can convince customers to build their artificial intelligence tools on the Google Cloud, as opposed to in these other clouds, which are primarily going to be using CUDA and other tools and cloud services, that could give Alphabet a big differentiation. The Gemini model that was just announced last week was a demonstration of that. That's something that They're going to be using that primarily for internal products, but they're also going to be licensing that to third parties. And Google Cloud is really going to be the big beneficiary of that. So I think this could be a tremendous growth opportunity for Google Cloud and for Alphabet. And I don't know that it's really priced into the stock. You can see that this is a massive business from a revenue perspective, but still has not contributed much to the bottom line. Just $372 million in operating income over the past year. If we get that up to industry standard margins, which are more like 20, 30% plus, this could be a very, very profitable business and adding tens of billions of dollars in operating income annually in just a few years. So this is one of the reasons to be bullish, and it's not really priced in if you look at a trailing 12-month numbers, that price to earnings multiple that I talked about earlier. So another great reason to be bullish on Alphabet. The third one is Waymo. If you're not familiar with Waymo, I'll give a little bit of a look at what they do. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Waymo is an autonomous driving company that is in Google's other bets. Now, this is not a business that has generated much in the way of revenue, has been spending hundreds of millions, if not billions of dollars each year to develop this autonomous driving technology. And what they're doing is they're currently partnering with Uber to basically distribute their autonomous driving vehicles in the Phoenix area, but they've also been operating their own network of vehicles and their own app in the San Francisco area. So the first thing you need to do with autonomous driving is build out technology. And Waymo has done that. They have put more miles and autonomous miles on the roads than any of their competitors. The main two competitors are going to be Cruise, which is owned by General Motors, and Zoox, which is owned by Amazon. But Waymo is far ahead as far as testing this technology and doing so in a safe way. Cruise, you might remember, is actually off the roads right now because of an accident that happened earlier this fall. So we have not seen any of those similar incidents with Waymo. Now, the question for Waymo is going to be, how do you get to market? For now, Waymo is partnering with Uber, and like I said, they're operating some of their own networks in some relatively small areas. But this is a potentially trillion-dollar market if Waymo or any of these other autonomous vehicle businesses can actually scale their operations. The question is Google and Alphabet going to be able to do that? They obviously have the funds to do it, but do they have the know-how or the desire to actually build an autonomous driving company, potentially a custom vehicle? I don't know that they will be able to do that long term, but again, this is not something that's priced into the stock. It's optionality and growth potential for Alphabet as a company. So these are some of the main reasons that I bought Alphabet stock. One, I think it's a very reasonable valuation, trading at near 20 times earnings for the next 12 months. You have tremendous growth and optionality in both Google Cloud and also the artificial intelligence tools that are starting to be rolled out. That could be the next phase of growth for Alphabet. And then you have other bets, particularly Waymo. That's one that I'm very excited about. And I think 10 years from now, this could be something that we're seeing on streets all over the world. So that's why I added more shares of Alphabet. I do think it still has asymmetric potential, although given the size of the company, it is on the lower risk spectrum of the stocks that I own. What do you think about Alphabet right now? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.